Thanks for tuning in to Talking Point. I'm your host, Neeraj. Our guest today is Mr. Krishna Karwa. Mr. Karwa, great having you. Thanks for joining and hope all is well.
Absolutely, all well. Thank you, Neeraj, for inviting me to the show.
No, the pleasure is entirely ours having you. And sir, interesting juncture to do this conversation, considering the fact that the whole theory of peak rates and rate cutting sometime in 2023, both on the West and otherwise, seems to be getting challenged by virtue of the data that is coming out. And the US CPI numbers would be something that would be keenly watched out for. Now, my question to you is, what is your thesis around what could a development around the reversal of the thesis of peak rates do to equities?
Yeah, Neeraj, so once again, thank you for inviting me to the show. And so I'm not an expert economist. Let's be first very clear about it. So my take is that, on every incremental data point, the markets keep on reacting upwards and downwards. And whatever I have also read about the incremental CPI data, etc., which will come. So again, markets have already done well in the last 1 month, 1.5 months in the US. So somewhere it reads a reason to correct. And also the bond markets over there, they seem to be indicating something different, which is that as of now, what we read is that there should be or maybe a correction in the second half of the year. So it's very confusing, to be very honest, to get every week, every 15 days, you have some incremental data. And I think every time people are reacting to it, but whether that's the right way to go about it. My fear is that, yes, I think looks like that interest rates will remain higher than normal, because despite all the effect has not yet come in of all the interest rate hikes which have so far happened. And the unemployment data, I think that is the most critical, and that doesn't seem to be showing any signs of indicating a slowdown in the economy per se. So the good part of the economy seems to be reacting, or rather pent-up demand seems to have been done with, but the services part of the economy doesn't seem to be showing a similar trend.
So what does that do to market sentiment? Because as we were talking about before the show started, volumes have taken a bit of a hit. We are more often than not stuck in a very tight range. If at all, there is a bit of a downward bias off late. But incremental volumes are happening, if at all, in only cases of extreme disappointments or extreme optimism when results come out or otherwise. So what does this do to the trading mindset of Indian equities per se? And do the recent or do the current valuations make India very attractive, or would you wait for some time?
Yeah, you rightly said. I think we are in a very lackluster kind of a zone where we are not getting any incremental data for the markets to move up sharply or even go down sharply. So if you see the quarterly results also, I think there have not been too many upgrades post the results. So which kinds of puts you into that category that kind of discounted, projections are all discounted, etc. So markets are in a lackluster kind of a mode. I think from an investor's perspective, looks like that it will test our patience. And having said that, so basically that means that you don't do too much of a churn to your portfolio until unless you're very sure on a bottom-up basis that you need to switch from stock A to stock B. That seems to be and that is reflecting in the volumes also of the non-institutional participants, which seems to be stable to tapering down. So that is very, very clear that it's a lackluster market which will test your patience. That's the sense that we get as of today.
Now, by virtue of the sell side reporting to you and the wealth management and the portfolio management services also under you, you would have a great sense of what both the global institutional investor as well as the HNI investor in India is thinking. Now, are there dichotomous views? When does that money start coming back, if at all? Is there some sense that you have either from the clients themselves or a hypothesis of your own?
As far as global investors are concerned, I mean, it was a given that all emerging market investors in the month of November, December thought that whenever the China reopened trade or valuations over there were attractive, far attractive. And it was a consensus trade, and it played out. It played out to the extent that we have seen a sharp rally in the Chinese markets. And similarly, at that point of time, also because of India's outperformance, the view was that valuations don't leave any great margin of safety on a broad level, and we have outperformed the global market substantially. So we should see some correction, time correction, etc. So it has played out to the T, and you can also see the kind of SPI outflows that we have seen. I think in the month of January, something like 25,000 crores, and in the first 2 weeks of February, again some 7-8,000 crores of selling has happened from the FPIs. So that is playing as per the script. There are no surprises per se, and it's reflecting in our indices also, which are playing in a very thin range, say 5% overall. I think 18,200, 300 on the higher side, and 17,300, 400 on the lower side, with global flows impacting, plus you have your local issues sometimes which come up. So it's as this is as far as the global investors are concerned. I think they are biding their time, waiting for better opportunities to invest. That's the sense that you get. And as far as local investors are concerned, I think there are two parts to it. I think the retail investor continues to keep his faith on. As we can see in the SIP inflows
SIP
into the
flows,
domestic funds industry, I think that continues. 12-13,000 crores of SIPs are flowing into the markets. So they continue to believe the long-term returns, etc. No doubt there is a fear that with interest rates or FD rates and bond rates, etc., now available, you can get 7-8% kind of returns. And with proper product, maybe even on a post-tax basis, also very attractive returns. So will that impact the flow into the equity market? So far, we haven't seen that. But there is a school of thought which believes that, or wealth managers who believe that there will be some asset allocation changes which will happen in portfolios. If you don't expect any great returns in equity for some time, and you're getting kind of secured 7.5, 8 or 8.5% kind of returns, then it would be attractive for many people to lock into those kind of returns. As far as the super HNI investor community is concerned, which I always say is quasi-institutional investors kind of, except that their risk appetite or to take proprietary positions on unknown stocks is very high. I think they have been very careful, and it's not only about today. It's been there for the last 6 months. They have been very, very vigilant on their portfolios, and they are in no hurry.
Have you been very careful too?
Absolutely, I think it remains the same thing, because on a bottoms-up basis, you are not getting too many sure shot winners. Let's put it this way, across market caps. And you can sense that it's a time to just do more of research, meet more companies. See, you need to look at it on a portfolio basis. So you may find a winner here and there that may become part of your portfolio. But overall, the market's willingness to react positively to very good numbers is very much limited. But the market's propensity to correct if the numbers are below expectations, or the growth is a few weeks, few quarters down the line, then you can see very sharp corrections. So the market is in that mood today to punish underperformance, but may not be ready to reward outperformance. So on a portfolio basis, investors are aware. I mean, we are all very clear that it's not going to be rewarding for some time. Maybe second half of the year could be better, but at least first half of the year doesn't seem to be in that mode.
Got it. Yeah, we've seen that performance in banks, for example, right? I mean, the numbers haven't been bad at all. We're not seeing any reactions. People are blaming it on over ownership. You reckon it's also the mood of the market coupled with the over ownership in banking?
No, I think it's more than, I think it's over ownership, and over ownership. I think there's nothing more, nothing less to it. And if you have the number one, number two private banks, or the number one public sector bank not reacting positively to super numbers, it's a clear-cut case of over ownership. In between, you did have a very good run in the tier 2, tier 3 public sector banks. I think that has also gone for a breather for various reasons. But I would imagine that the best I mean, if the biggies don't react, then the tier two, tier three valuation and everything will be a function of that. So I think it's an over ownership case. And yes, there is no follow-up buying. So where is the question of investors putting in incremental money or trying to make money over there?
Yeah, that's true. In which case, should a portfolio strategy, as you said, be to research but wait to buy the good names at better valuations or at a future uh, point of time in the year?
I would just make a small correction to that, is that research, fair point, you have to keep on doing it, and take your own independent call as to when to buy, because there are, you will, it's not that you can time it to the T. So if you believe that you have broadly covered all the fundamentals and the valuations are attractive, then you buy and you keep powder dry to be able to average out or accumulate over a period of time.
Got it. Sure.
But to be, no one can judge where the bottom of the market or the bottom of the stock, etc. is. So I think if you like a story, you invest in it and be prepared to be patient. I think the most important thing is that you should be patient, that the markets will not reward you in a hurry.
Sure. Got it.
That is something which we'll have to be very careful about.
Okay. So we spoke during Diwali, I remember. I'll come to your dark horse because it intrigued me then, and I'll talk to you about it again. But let me first talk about things that people are largely constructive about when it comes to 2023. The belief is that aside of banks, which we spoke about as our own, autos seem to be a pocket that fits in the bill of most people. I wonder if you are sanguine about the prospects of the auto sector for not just 2023, but let's say the next 24 months.
See, I think in terms of number of revenues, etc., I'm sure the autos will deliver because of the various product launches, the order book position, the waiting period, etc. And also now the input prices have also stabilized or corrected. So there is no doubt about the fact that the companies will deliver on their expected revenue for the next at least 12 to 18 months. I mean, until unless there is a massive correction in demand, etc., which it will look like. Now, as far as the returns that many of these stocks will deliver, I think it will be nothing great as such, because it's kind of a discovered story. So whether it is the passenger vehicles, whether it's the commercial, so there doesn't seem to be any massive upside left. So you could possibly be a trader, yes, and but can you make some great returns until unless you time your entry exit, because these are very, very well discovered, well researched stories. So to that extent, autos, my sense is that will give you return, market returns possibly, but there can't be any significant outperformance in the whole auto space. And specifically, I'm very, very careful in that whole category in the two-wheeler space, because that's the one which seems to be getting disrupted in a hurry.
Yeah, so the lower valuations are not compelling enough in the two-wheeler space. The disruption possibilities are very high.
I don't think so. Because where is the growth is not coming in. I think the growth is a challenge in some of the companies in the two-wheeler space, and they are the one which are, I think, going to get disrupted because of the ongoing, I mean, the way the EV part of the cycle is playing out.
Most certainly.
Companies which have global exposure, they also seem to be having their own challenges. The local demand is also somewhere looks like penetration has it reached its peak. The local penetration.
Okay. A pocket that you had mentioned could be a dark horse, if I'm not wrong, was the whole financial services space, broking, and maybe AMCs, I don't quite remember, but I remember the financial services space, non-lending financials, and particularly in the capital markets over a 5-year period. That is what I remember you had spoken about. Now, are you still constructive on that? Because incrementally, with the number of added users going off, with the volume activities doing the way they are, the numbers haven't been particularly great in not just the last quarter, but maybe the last couple of quarters for these companies. So why the optimism, if it's still there, that is?
No, definitely what you say, and yes, I continue to be. We continue to be positive. See, I think there are 3, 4 spaces I had mentioned that time to you, including insurance. So, if you have forgotten, I am mentioning it to
I had
you.
forgotten, sorry.
So the thing is that valuations post that have become more attractive only. That is there, and these businesses have I mean, at least the broking part of the business has an element of cyclicality also. So valuations of many of these companies are reasonable, and the growth prospects don't go away. So my sense is that if you are have a decent long-term view, so whether it is the wealth management business, whether it's the AMC, broking, and insurance, I think the path for growth is a long path ahead of them in terms of the penetration itself. And so that will play out. Currently, what we are seeing is a kind of a consolidation kind of a phase. As far as insurance is concerned, I think there is concerns on because of regulatory expected changes, etc. But my take is that the sheer penetration or under penetration of all these products will take you through, and if you back the right companies, you will still make good returns. Companies which have diversified their revenue streams as far as the broking, wealth management kind of businesses are concerned. So then we can clearly see that who will become the winners over a longer time frame. So now is the time to build your portfolio on that segment if you are having a sufficiently long time horizon. I think the challenge is that many investors look for returns immediately, which may not happen.
That's true. My final question, and that is on the capex plays, the much spoken about theme. We've seen the numbers come even this quarter. And if indeed the commodity costs are lower, then the base effect helps them post very good operational metrics for a better part of 2023 too. But the problem might be that save for an LNT, most of the other stocks are not cheap. If anything, they are fairly expensive, particularly the MNC ones. Purely cap goods and engineering. I'm not talking about infrastructure here. So what gives here? Are you constructive on the cycle, and therefore do you believe that these might be expensive currently, but future earnings will kind of help fill in for that growth numbers that they are, of the valuations that they are currently, or are you skeptical?
No, so we have been positive, and yes, it has delivered. The whole segment have delivered decent returns, and from here on, I think, so valuations wise, it doesn't leave too much on the table. So that is this thing. But I think if you work on it on a selective basis, there will still be stocks within the segment sector which could possibly give you good returns. I would like to add over here that if you look at the cement companies' numbers, I think the EBITDA margins, etc., which have come for many of the companies, have been on a decent uptick. And going forward, also, you can possibly see a further uptick in the EBITDA margin that many of these companies will, or EBITDA per ton that these companies will. So there, the valuations of most of the cement companies have come off over the years, over the last 6 months. So there, it looks attractive. So I would also add, so that's a segment that investors should be looking to invest in, both from a valuation opportunity, and the expected benefit rub-off of the various capexes or infrastructure spending that the government of India is doing and will continue to do. And also the housing segment of the market also seems to be doing well. So I think cement companies could be a good place where you are entering at valuations which are reasonable. I'm not saying that they are cheap, but some of the smaller companies are relatively cheap. But I would say that overall, the whole basket looks really interesting.
Great. Well, thank you for sharing your thoughts. Thanks for the practical wisdom as well around the volumes and the activity levels and the views. Lovely talking to you as always.
Thank you. Thank you very much. Thank you, Neeraj. Thank you for inviting me.
The pleasure was ours. Viewers, thanks for tuning in.